Hi, I'm Ed, bringing you Smart Monday's first video investment update. Today we're going to explore ultra-low interest rates, whether they'll stick around for the long term, and what that might mean for your super account balance. The cash rate has reduced twice this year and is currently sitting at historic lows of 1%. For every $1,000 you have invested, you'll get a return of $10. It's a small return, and that's big news. The change represents the first tweaks from the Reserve Bank since 2016 and are in response to weak economic growth, concerns around consumer confidence, and a vulnerable housing market. There's also a lot going on overseas that should concern investors. Despite all the commotion, the Australian stock market is currently around its all-time highs. It's weird. It's an unusual situation, and I'm going to cover the key investment points to provide members with a snapshot of how their investments might perform. The global financial crisis is a useful starting point to understand ultra-low rates, which have been the norm for many countries since. Economies were more exposed to the problems that sprung up during the GFC, and they had to act aggressively. As examples, the European Central Bank, called the ECB, and the Bank of England both lowered their cash rates to 1% in 2009. Australia was the lucky country and avoided having to make such drastic decisions then. Fast forward a decade, and these economies still have very low interest rates. Would you believe the ECB deposit rate is currently a negative 0.4%? For every $10,000 invested, you'd have $40 less at the end of the year. As an indicator of how long Australian rates may be low, we can look to the yield of longer maturity Australian government bonds, where the 10-year bond currently yields a tiny 1.3%. This implies investment strategies relying on cash and bond income to deliver returns are likely to offer lower returns over the long term. In bonds, we're thinking about what types of investment strategies are needed to continue to hit our return targets. Our selections might include strategies that target a positive return in all markets. When bonds and cash offer very low yields, it makes sense for investors to focus on other asset classes for growth, and this is part of the reason why share markets are doing so well. This demand for growth is pushing shares up and has contributed to the historically high share prices we have today. This has really benefited our younger MySuper members who have held a high exposure to shares and have achieved strong returns in the first half of this year. The new Morrison government has also chipped in, passing tax cuts, which should help with consumer demand. As the news comes through and governments react, we're expecting to see markets respond strongly up and down as they did at the end of last year and the beginning of this year. This volatility might be more concerning for older members who may desire more stability over achieving a high return. If any member is unsure of their investment strategy, I'd suggest a shout out to our smart coaches who offer advice on Smart Monday investments. This brings me back to the original question. With a lot of market uncertainty, are ultra-low interest rates here to stay in the long term? Our view is probably yes.